Everyone told you that being self-employed would lead to the ultimate financial freedom. So you went out, you started your own business, you stacked some cash, and now you want to go purchase a home, but the banks are telling you that you don't qualify for a mortgage that you easily deserve. Here's the secret. The main issue isn't your income, it's the type of loan you're trying to qualify for. In today's episode, we're going to give you a simple breakdown of what a QM qualified mortgage is versus a non-QM or non-qualified mortgage for self-employed borrowers and real estate investors. I'm Ryan Marks, host of SEI Podcast. I've been in lending now for over 20 years, and during that time, I've worked for some of the biggest banks to ultimately transitioning over to the mortgage broker side because I feel that everyone should be able to achieve that dream of home ownership, whether you're purchasing a primary residence, a rental property, or a second home, whether you're purchasing a primary residence or building your real estate portfolio. And unfortunately, qualified mortgages oftentimes can be difficult to qualify for if you're self-employed. I can't count the number of times that I've seen a loan denied by someone who owns a profitable business just because they didn't fit into the traditional lending box. Regardless if you work with us, this episode is going to open the entire playbook that most loan officers never explain to self-employed buyers. So before we unpack what the non-QM loan is, it's important to explain what a traditional conventional QM loan is. It's a mortgage that meets strict government standards set forth by the CFPB or Consumer Financial Protection Bureau. Ultimately, it's like a safe box for banks and lenders because they're going to ultimately sell those loans to Fannie or Freddie. They mainly aim towards approving loans based on wage earners or W-2 employees, and if you're self-employed, you're going to have to provide at least 1, if not 2 years of your tax returns in order to qualify. The underwriter that's qualifying the loan is not going to take into consideration all of the many tax deductions that are within your legal right as a self-employed borrower in order to qualify for that loan. They're going to ignore that and essentially just use what the gross adjusted net income is listed on your tax returns. So this works great if like you're a standard W-2 salaried employee where you just don't have an opportunity to take advantage of a lot of deductions. But what about more complex income scenarios for those of us who are self-employed or real estate investors? The challenge with QM mortgages for entrepreneurs are we have within our legal right to take advantage of many of these tax deductions available when we're considered self-employed, which is great 90% of the time. But when it comes time to purchasing a home, the bank's only going to use that net income, which is often dramatically reduced from what your gross earnings are. And more often than not, I see a negative number on the tax returns, meaning you took advantage of the deductions to essentially wash out all of your revenue generated. But in addition to that, you're showing a negative number on your tax returns, essentially giving yourself a zero income available to qualify. That's just you optimizing your taxes, but you got labeled too risky by the banks as far as QM guideline standards are concerned. So to simplify, qualifying for a QM loan, you have to meet a debt to income ratio, meaning the amount of debts that you currently have, including your vehicle, student loans, credit card payments, all those existing expenses that you're taking on, in addition to the new home that you're purchasing, can't exceed a certain percentage of your total income. So typically a conventional loan, that debt to income ratio cannot exceed 50%. If it does go up that high, it's not like you're automatically going to qualify at that 50% mark. You still have to use a system called a DU approval or a desktop underwrite, which is essentially your loan officer running your entire loan scenario through a software which analyzes your credit reports, your assets, your overall payment history, and then ultimately gives you a decision whether you pass or fail to go to that higher number. And in order to get to that 50% number, that's essentially all of those existing expenses with your new housing payment divided by what your qualifying income is. And the bank is going to derive that qualifying income from your tax returns. So your company may feel successful as it's bringing in all this revenue, but the system says you're barely earning enough to get by because after you look at your gross adjusted net, that number may be much smaller than what your total sales were throughout the entire year. In addition to the debt to income ratio used to qualify, there's another big box that has to be checked, which is the ability to repay rule. This is one of those rules that was set forth by the Dodd-Frank Act, which essentially simply means you need to show the bank or the investor that you have the means to continue to pay this loan moving forward on whatever loan terms that you took. So why that's so important is non-QM loans still use the ability to repay rule. So to qualify for a non-QM, it has similar guidelines to a traditional mortgage, meaning that you have to prove your ability to repay, but it uses other forms of documentation to qualify that income in order to meet that ability to repay. So the goal of the non-QM loan still follows some of those traditional guidelines. However, that doesn't mean you have to fit into the W-2 wage earner box. There's numerous non-QM loan products available that use other forms of qualifying your income in order to meet that ability to repay rule or debt to income ratios if it applies to that loan product. Some of those great loan products would be the bank statement loan, where we're only qualifying using your most recent 12 or 24 months bank statement deposits, or a profit and loss loan, where we're essentially only using your P&L in order to derive income and no other income documentation is necessary. And the same thing goes with a 1099 loan product. Another fantastic product that's used for investing would be the DSCR loan, where essentially you're using the property's cash flow derived in order to qualify that loan, and it uses no debt to income ratio whatsoever. Aside from the bank statement loan probably coming in at number one, the DSCR loan comes in at a close second as the most highly utilized non-QM product. I don't want you to get the wrong idea. The non-QM space isn't the wild, wild west of the subprime days, where loan applications or a 1003, as we call them, would have little to no information on there other than maybe your name and your social security number. There are still these regulations as it pertains to guidelines in order to qualify that loan. You have to understand that the investor wants to ensure that you can repay the loan and does not want to take your property away from you. They don't go into writing a loan thinking, I hope you can't make these payments so that way we can take this home away from you. So before we finish diving into the non-QM world, I think it's important to debunk some of the myths associated with non-QM. The biggest one being that non-QM equals a subprime loan or irresponsible lending. That couldn't be further from the truth. Again, remember, you have to understand that having that ability to repay rule is very important piece in order to qualify for a non-QM mortgage. You know, there are regulations associated. It's not the wild, wild west of the subprime days where your loan application could have little to no information other than maybe your name and your social security number. The days of strictly, stated income or providing no information about yourself has been done away with as part of that Dodd-Frank Act. The second myth is non-QM interest rates are often drastically higher than traditional QM mortgages. Again, that's false. Typically, for a bank statement loan, for example, the interest rate on average is only an eighth to a 0.25% higher than a traditional loan would be. And furthermore, in that particular product, you can actually go up to 90% loan to value and there's no monthly mortgage insurance. Whereas if you're using a traditional qualified mortgage and you're putting less than a 20% down payment, you're going to likely have monthly mortgage insurance as part of your payment in addition to the regular principal and interest mortgage payment and your taxes and insurance. The last myth worth busting is only the wealthy or the credit challenged borrowers can use a non-QM loan. The truth of the matter is that the majority of people utilizing non-QM have solid credit, you have assets, your business is showing profits. We're just checking what these normal W-2 boxes would be, and the reality is it's just a different type of documentation for those of us that don't fit into these W-2 wage earner boxes. So let's take a look at how these non-QM loans would be best used. Some of the top professions that are considered self-employed as far as the banks are concerned would be a freelance writer or editor, a graphic designer, you run an e-commerce business, you're a contractor working on homes, you're a handyman, you're a consultant, you're a business coach, you're a real estate agent, you're a ride-share driver. If you're not receiving a standard salary, and let's say you're receiving a 1099, as far as the bank's concerned, you are considered self-employed. You could have also transitioned from a W-2 wage earner job into self-employed. Let's say you were a nurse working for a hospital receiving a W-2, but now you've gone out on your own, you're working for multiple hospitals, you're independently contracted, and you're likely receiving now a 1099, you're considered self-employed. Or you have a brick and mortar business where you're selling a product, and even if you're not incorporated with an S Corp or C Corp, you're a sole proprietorship, you only file an individual personal return, you're still considered self-employed. The bank is going to look at what your gross adjusted net is on those taxes, and depending how good your CPA or your tax preparer is, you may show little to no income. Even if you W-2 yourself, let's say you give yourself a salary. Your tax preparer, your CPA advises that for tax purposes. However, you have additional write-offs that are reporting under the self-employed section of your tax returns, and that number shows a loss. That's going to pull away from your W-2 wages earned. So for example, if you W-2'd yourself for your own business, a $60,000 salary annually, and you took a $20,000 loss on the remainder of your business, well, your wages are now $40,000 remaining, and that's the income that's going to be used on a traditional QM loan in order to qualify you for your property. Or you run an e-commerce business where you're depositing all the revenue into your bank account, whether that's personal or business bank statements. At the end of the day, that income that's reported on taxes is what's going to be used to qualify your home in the QM sense. So in all of these examples, these are a perfect fit for non-QM mortgages. For the business owner receiving deposits into your bank account, the bank statement loan, for example, will only use 12 or 24 months of your most recent bank statements in order to derive that income that we would use in order to qualify you for your home, and no other income documentation would be needed in order to determine what your qualifying income is. On top of that, a lot of the investors that we work with allow for a debt to income ratio on this loan product up to 55%. And it does not require your standard DU approval, meaning if you go up to that 55%, you may need some other compensating factors like, do you have some additional assets available, or what is your loan to value or your overall credit history? But at the end of the day, you have the ability to go up to that 55% mark a lot easier than you would having to reach that 50% mark in the qualified mortgage space. Or let's say you're a property investor and you're purchasing property with the intention of renting it out and making income, whether that's long-term or short-term, like an Airbnb or VRBO. If you have more than 10 properties financed currently, you cannot use another qualified mortgage. You're cut off. As of right now, you can't exceed that property mark, whereas a DSCR loan, there's currently no limit. And on top of that, this program also has the ability for you to easily vest as an LLC or in your corporation. And on top of that, we work with investors where this mortgage actually does not report on your credit, meaning that if you were to go out and buy a primary residence, you wouldn't have to worry about taking this housing payment into consideration on your loan, as it's isolated within your investment portfolio. So to briefly explain how a DSCR loan works is, it's very similar to a commercial loan, meaning that the investor is going to qualify that loan based on what the property cash flow is. It does not use any sort of debt to income ratio whatsoever. So for example, if your mortgage payment on the property you're looking to purchase is $2,000 a month, including all the taxes, insurance, and potential HOA, and the rent that you're receiving is $2,000 a month, that is a 1-to-1 debt coverage ratio, which is essentially the baseline, meaning that you can proceed with a DSCR loan because that loan debt coverage is based on the rent it's receiving against how much the monthly payment is. And in future episodes, we're going to unpack that DSCR loan where there is investors available that will even go as low as no ratio, meaning regardless of the rent or lack thereof that it receives, there is still financing available. So hopefully this episode has given you a better understanding of what QM is versus a non-QM loan, and there are so many phenomenal products out there that are specifically designed for self-employed borrowers in mind. So at the end of the day, the QM loan favors the W-2, whereas the non-QM favors the real cash flow your business earns. Remember, if the big banks keep saying no, they might just be looking in the wrong loan bucket. So if you're still running into roadblocks and the bank is telling you no, it may just be that they're looking in the wrong loan box. And if you're interested in calculating your own income for some of these programs like the bank statement loan, feel free to head over to scimortgage.com, where we have tons of tools and resources and other information about these great loan products and ways to get in touch with us. Thanks so much for joining. I'm Ryan Marks, reminding you to let your money work smarter, not harder.